Okay, let's unpack this week. Imagine a week where the signals from the world's biggest central banks could just send currencies swirling. And there are these surprising facts kind of hiding in plain sight. That's exactly the kind of deep dive we're taking you on today. We're zeroing in on the top 10 macroeconomic events set to really impact the Forex market from July 21st to July 28th, 2025, our mission.
Yeah.
Well, it's to cut through the noise, pull out the most important nuggets, and give you a clear roadmap for understanding what's driving these market movements.
Yeah, and to help us sort of navigate this pretty intense week, we've looked at comprehensive financial analysis reports, detailed market data, the works, and a really strong theme is emerging. It's this potential for significant policy divergence, between the U.S. Fed and the European Central Bank, the ECB. And this isn't just like a technical point. It could fundamentally shift how investors view global risk and where they think interest rates are headed, sets the stage for some serious currency shifts.
And, as I was going through the reports, this one thing about the euro really jumped out at me right away. It's apparently in what the market calls an overbought state. Our sources show speculative net long positions on the euro. They hit an 18-month high. What does an overbought euro really mean for us here? Especially with that kind of positioning.
Right. So what that tells us, connecting it back to the bigger picture, is that, well, a lot of traders are betting very heavily on the euro going up. And it's not just a slight lean, it's a massive concentration on one side. This creates what the sources call an asymmetrical downside risk. Think of it like a seesaw, right? Weighted heavily on one end. The euro just has much further to fall than it has to rise if things don't quite go its way, particularly if the ECB, sounds more cautious than those traders expect. It's a precarious spot.
Wow. Yeah, precarious sounds about right. Okay, so let's dive straight into the heart of it then. It really kicks off with the ECB. We've got their monetary policy decision and President Christine Lagarde's press conference, both on July 24th. Why is the press conference maybe more than the rate decision itself the real main event here?
Well, it's interesting is that the ECB, they're widely expected to keep policy rates unchanged. I mean, they've had a series of cuts starting back in June 2024, going through June 2025. So the actual rate change, probably not the big story. Like you said, the real focus is Lagarde's press conference. Investors are going to be hanging on every word, looking for clues about the future path, especially since the September meeting is flagged as a live meeting, meaning, policy could genuinely shift then. And this is all happening against, well, complex background. Eurozone inflation is kind of hovering around the 2% target, which is good, generally. But these new trade tensions, potential U.S. tariffs on EU goods, China, that's creating some significant uncertainty for the economy.
Okay, and to sort of make sense of all this complexity, our sources use this framework, a 5-model analysis. Sounds quite thorough. It helps understand the full spectrum of impacts. Out of those 5, which one is really like flashing red for the euro right now, given everything you just said about its positioning?
That's a great question. Look, all 5 models play a role, obviously. But the OFI, the order flow imbalance, that's the one that truly stands out for the euro right now. And this brings us right back to that overcrowded long position we were just talking about. Large speculators, their net long euro positions are, at an 18-month high. Like I said, it's a massive bet on one side. Over 2/3 of the market positioned for rally. Now, you couple that imbalance with the VBP, the volatility breakout probability, which shows one-day implied volatility for EURUSD is, get this, over 200% higher than its 20-day average.
Wow, 200%.
Yeah, so the market is basically bracing for a huge price move. Doesn't really matter which way. Put those two together, the OFI and VBP, and you get a really dangerous situation, significant downside risk.
So putting those two together, the huge bet on the euro, the market expecting massive volatility. What's the quick takeaway here? What does this really mean for the euro?
The key insight, I think, is that the market seems to have already priced in a neutral or maybe even a slightly hawkish ECB outcome. So if Lagarde emphasizes those external risks, the U.S. tariffs, and it sounds even a little bit dovish, it's going to seriously disappoint all those people holding long positions. And you could see a large-scale, maybe even forced liquidation of those longs, which could cause a sharp, fast drop in EURUSD. The potential for it to fall sharply is just much, much greater than its potential to rise, even if the news is just, mildly disappointing. It's like everyone's crowded onto one side of a boat, right? Just takes a small wave to potentially tip it over.
Okay, so the sources are actually putting numbers on this. They see, a 65% chance of a dovish hold, where Lagarde highlights recession risks from trade, keeps the door open for a September cut, and that pushes EURUSD down through support levels, versus only a 35% chance of a hawkish hold. where she focuses more on the improving data, implies they'll pause cuts for longer, which might cause a small, maybe brief, short squeeze for the euro. Is there any counterargument, though? Anything from the other models that could actually, prop up the euro?
Yeah, I mean, while the main risk is clearly down, the other models do offer some, let's say, counterpoints. Take the RORO, the risk on, risk off sentiment index. If Lagarde really emphasizes the positive economic surprises and Eurozone data has been beating expectations recently, that's important. That could spark a bit of risk on sentiment, provide some support. And then there's the IRDS, the interest rate differential shock. That's always a factor. If she sounds genuinely hawkish, really signals they're holding off on cuts, that could narrow the big interest rate disadvantage the euro has against the US dollar. That could give it a boost. But honestly, those factors are kind of fighting against a pretty significant technical headwind from that positioning we talked about.
Right. Okay. So as we're thinking about Europe, there's a similar sort of drama playing out across the Atlantic. Let's turn to the U.S. Fed. What's the tight spot Chairman Jerome Powell finds himself in? He's speaking at a banking conference on July 22nd.
Yeah, the Fed's in a classic bind, really. They're trying to balance potential inflation, maybe coming from the Trump administration's tariffs, which would push prices up, against this sort of persistent uncertainty about economic growth. So the market's going to be looking very closely for any tiny shift from the Fed's current wait-and-see stance. I think the biggest blind spot for the market might be how seriously the Fed actually views those tariffs as an inflationary force rather than just something that slows growth.
And if we apply that five-model analysis to Powell's speech, what's the most crucial insight for the U.S. dollar that jumps out?
Well, for the dollar, the OFI, order flow imbalance, is again incredibly important, just like with the euro, but kind of the opposite situation. Asset managers right now, they're holding near record net short USD positions, lots of bets against the dollar. So that sets up a pretty significant short squeeze risk for the dollar.
Okay, explain that again quickly, the short squeeze.
Right, so imagine lots of people bet a stock, or in this case, the dollar, will go down. They borrow it and sell it, hoping to buy it back cheaper. But if it suddenly starts going up instead, they all have to rush to buy it back to limit their losses. And all that sudden buying just drives the price up even faster. That's your short squeeze. So if Powell delivers an unexpectedly hawkish message, maybe about inflation, it could force a massive unwinding of these short dollar positions, and the USD could surge. And also relevant here is the ROR index, the risk sentiment, the VIX, the market's fear gauge is around 16.41. The RVE index for bonds is about 83.29. That suggests a pretty sensitive market, kind of bracing for turbulence. So a hawkish Powell talking up inflation risks, strong economy that would likely be seen as risk off, which usually boosts the USD as a safe haven. A dovish tone, though focusing on growth concerns, hinting at earlier cuts that would be risk-on and likely weaken the USD.
So another potential shock here from Powell this time, and it sounds like maybe the market's got this one wrong too. Betting against the dollar when Powell might come out hawkish.
That's precisely the point the sources are making. Yeah, the market is, by and large, betting on Fed rate cuts, partly because they think tariffs will hurt growth. But, the Fed's core mandate is inflation control. That's job one. So it seems highly probable Powell will use this speech to affirm that tariffs are a potential source of inflation, which implies the Fed really can't rush into rate cuts. And a message like that, it would directly contradict what a lot of the market expects. Could easily trigger that strong USD short squeeze we talked about. It's a real chess match this week. Central banks making their moves, the market trying to guess what's next.
Yeah, definitely. And the sources outline two scenarios for Powell, too. A 70% chance of a hawkish neutral stance. Powell reiterates U.S. economic strength, highlights the tariff inflation risk, signals caution on cuts, leading to a stronger dollar. Or a 30% chance of a dovish shift, where he sounds really concerned about tariffs hitting growth, hints at acting sooner, causing the dollar to drop sharply. What really stands out here is how understanding these conflicting positions in the market and within the central banks is just absolutely key. You have to anticipate these big currency moves. It's not just data points, it's a whole narrative. Okay, shifting gears a bit from the central banks themselves, let's look at the key economic data hitting this week, especially what the sources are calling a Super Thursday of data. The global Flash PMI is on July 24th, and they land right alongside the ECB meeting.
Yeah, Super Thursday sounds about right. These Flash PMIs, they're really crucial leading indicators. They give us the earliest comprehensive look at how manufacturing services are doing in July across the US, the Eurozone, the UK. And in fact, they drop at the same time as the ECB meeting. That's going to absolutely guarantee high volatility, especially for euro and sterling pairs. But what's really captivating here is the clear divergence these PMIs are expected to show. The current forecasts really paint this picture. You look at the Eurozone and UK manufacturing numbers, They're expected to stay below 50. That means contraction, right? Even if they tick up slightly. But then you look at the U.S. manufacturing PMI, projected to stay above 50, showing solid expansion. Now, if the actual data confirms that, or even worse, amplifies that divergence, say, a really strong U.S. number and weak Eurozone UK numbers, well, that creates a very powerful argument for a divergence trade.
Okay, divergence trade.
Yeah, it's pretty fundamental macro trading. You buy the currency of the stronger economy, in this case, likely the US dollar, and you sell the currency of the weaker one, like the euro or sterling. It's driven by these real economic forces, tells you a lot about the relative health of different regions. The sources actually put probabilities on this too, about a 60% chance they see of divergence confirmed,
Yeah.
a 30% chance for unexpected convergence, maybe things aren't so different, and only about 10% for data consensus, where everything just kind of lands as expected.
Right. Okay, next up, let's look at Germany, the Eurozone's economic engine. We get the IFO index on July 25th. What's the key dynamic to watch here?
So the IFO index, yeah, it's a key leading indicator for German business sentiment. It's expected to improve slightly. But what's really important here is that classic buy the rumor, sell the fact dynamic. You might see the euro get a little bump higher based on positive expectations before the data comes out. However, if the actual number misses the forecast even slightly, or if you dig into the subcomponents and they show underlying weakness, the euro could reverse those gains really quickly. A weak IFO would just reinforce the pressure on the ECB to stay dovish, which would likely be negative for USD and maybe your CHF too. It's a good example of how sentiment can just flip on a dime.
Okay, and what about the UK consumer? We're looking at UK retail sales data, also on July 25th.
Yeah, this one looks interesting because it has the potential for a really big surprise. The forecast is for a dramatic rebound, like plus 2.0% growth for June. That's after a sharp drop of 2.7% in May.
Wow, that's a huge swing.
Exactly. So that big difference creates potential for a surprise. If the data meets or, beats that 2.0% forecast, that would signal pretty strong consumer spending, which would ease pressure on the Bank of England to cut rates quickly, and that should provide strong support for the pound sterling for GBP. But because the expectation is so high, there's also a very high volatility breakout probability for GBP pairs around this release. It's definitely a high-stakes moment for the UK economy.
And finally, there's this ongoing shadow that's just always lurking over the markets, isn't there? The US-EU and US-China tariff risks. How do these constantly shifting situations factor into our deep dive for the week?
Yeah, they're a continuous asymmetrical risk, meaning the downside impact is usually bigger and faster than any upside. So any negative news, think new tariffs suddenly being imposed, or maybe trade talks breaking down, that would immediately trigger strong risk-off sentiment. Investors would likely flood into safe haven assets, the US dollar, Japanese yen, Swiss franc, and conversely, you'd see sharp sell-offs in currencies that are sensitive to trade and global growth risk, like the Australian dollar, the New Zealand dollar, many emerging market currencies. ODUSD and USDCNH, the offshore yuan, are particularly sensitive to these headlines. Now, positive news is possible, of course, but it often has a less sudden impact, partly because the market's kind of gotten used to this baseline level of uncertainty. What really stands out here is just how these geopolitical tensions, even without a specific date attached, are a constant, powerful force, like a low hum in the background that can just turn into a roar at any moment.
Okay, let's just quickly touch upon a few other data points this week. Maybe not the main drivers, but they contribute to the overall picture. First, the EIA crude oil inventories on July 23rd.
Right, these weekly U.S. oil reserve reports, they obviously impact oil prices, which in turn correlates with currencies of big oil exporters like the Canadian dollar, CAD, and the Norwegian krone, NOK. But beyond that, shifts in oil prices can influence global risk sentiment more broadly. And they can even affect things like gold, XAUSD, mainly through inflation expectations. So it's got these ripple effects.
Okay. And next, Canadian CPI data on July 22nd.
Yeah, this is the big one for Canada. It's the most important inflation data for the Bank of Canada, the BCS. It will significantly shape expectations about their next move on monetary policy. If inflation comes in hotter than expected, well, that could lead the BOC to keep rates higher for longer. That would support the Canadian dollar. On the flip side, lower inflation could open the door for rate cuts, which would likely weaken CAD. It's pretty direct linkage there.
And finally, a couple of U.S. regional indicators. The Richmond Fed Manufacturing Index on July 22nd and the USCB Leading Index on July 21st. How should we think about these?
Yeah, these are probably best thought of as confirmation tools rather than primary market movers. The Richmond Fed Index gives you a read on manufacturing in that specific region. The leading economic index, or LEI, combines various data points to try and predict future economic activity. They definitely add pieces to the overall U.S. economic puzzle, give us more context on economic health, but they're unlikely to cause major market shifts on their own, unless there's some kind of really extreme deviation from the forecasts. I think what's important for you, the listener here, is to sort of prioritize. Understand which data points are likely the biggest drivers and which ones mostly provide, supplementary context.
Right, okay, so pulling all these threads together, what does this all really mean for you trying to navigate this pretty high-stakes week?
Stepping back and looking at the whole picture, the pair with the most potential to watch this week. It's definitely EURUSD. I mean, it sits right at the center of the week's most critical events. You've got the ECB meeting, the Flash PMIs hitting both sides, and it has that really clear order flow imbalance we spent time on, particularly those overcrowded long positions. Now that presents potentially an attractive risk-reward setup for selling the euro, for being short EURUSD, because even if the ECB somehow sounds surprisingly hawkish, that fundamental policy divergence with the Fed, that would likely limit how far the euro could actually rally. It's almost like the market has laid out this really clear bet, and now we're just waiting for the central banks to show their cards.
Okay, makes sense. With all that in mind then, what are some key risk warnings for the week? Like things that could just completely flip these expectations on their head?
Yeah, there are definitely a few significant ones to keep on the radar. I'd say the biggest risk, especially if you're leaning towards a strong US dollar view, would be if Chairman Powell unexpectedly shifts really dovish. Like if he suddenly prioritizes growth support way over inflation concerns related to tariffs, that would almost certainly weaken the USD across the board. Another big risk, a surprise trade agreement. Any sudden positive news about a US-EU or US-China tariff deal, that would trigger a strong risk-on rally, which would hurt safe havens like the USD and JPY and give a big boost to risk-sensitive currencies, AUD, NZD, even the euro. And finally, watch that UK retail sales number on Friday. If it rebounds much stronger than that, plus 2.0% forecast, that could really force the market to rethink the Bank of England's path, strongly supporting the pound, GBP, and causing some significant volatility in sterling pairs. So yeah, those are the sort of wildcards that could definitely change the game this week.
Okay, so bringing it all home then, what's a concise strategy for the week, maybe broken down chronologically? How might someone approach this?
All right, thinking chronologically. Early in the week, say Monday, Tuesday, July 21, 22, you might cautiously consider building some USD long positions, maybe against relatively weaker currencies like the Aussie or the Canadian dollar. This would be ahead of Powell's speech, anticipating that potentially hawkish tilt. Then, midweek, Wednesday, Thursday, July 23, 24, you need to prepare for major volatility around USD. Think about prioritizing sell stop orders if you're already long or looking for potential short entry points after you get signals from the PMI data and the ECB press conference. Don't front run it. And given the high volatility expected, maybe using options for risk management could be particularly useful around then. Finally, late in the week, Friday the 25th, the focus shifts a bit towards GBP pairs with that retail sales data. Look for potential breakout trade opportunities if that data delivers a really big surprise, either way. Overall, it's shaping up to be a really dynamic week, so staying flexible, being ready to adapt, is going to be absolutely key. In this world just flooded with constant information, the real superpower isn't knowing everything. It's knowing which specific nuggets truly move the needle. So as you process this deep dive we've done today, maybe ask yourself, what's the one piece of data or one event you'll be watching most closely this week and why? What's your key focus?